Very good evening and welcome to the grand finale. India's largest BFSI summit, and what a way to end it. Conversation, candid chat with RBI Governor Shaktikant Das. He is the second governor in RBI's history to have 6 years now. And you don't know whether the 6 year could be 7 or 8 years. We get to know a year later. Before coming here in that special room, governor was asking me that what kind of bowling you do, spin or first or medium pace. There are others. I said that whatever try to I bowl, this is one batsman, you can't get him out. You just can't get him out. When it comes to communication, he is the central banker. Sir, this lady already has stolen my thunder, but still, officially on this platform, in presence of 750 or 800 people here, and thousands of people who are watching this on web, let me congratulate you for two things. You are ranked A plus governor globally in the Global Finance Center 2023. You also bagged the title of Governor of the Year for 2023 by Central Bank in London. So, congratulations, sir. So, if it's Central Bank's World Cup, India is champion and you are the captain of the team. Right? Only thing, it's not 20 over cricket, it's not 50 over cricket, it's not even a 5-day test match. It's a test match which runs for years. So, and which is a test match which has seen COVID, which has seen everything. So once again, Governor, incidentally, Governor is very fond of cricket. So that's why I'm giving the cricket analogy. So let's start with something macro. Once again, another congratulations is due because we are a part of the JP Morgan Index, the global index which everybody had been waiting for. India has 10% weightage in the global diversified index in stages from June 2024, 1% added every month. Now, RBI, the central bank, you have been preparing here for quite some time. 2020, first you removed the foreign ownership in certain bonds, you call it fully accessible route, you have done that. And then, of course, allowing the banks to lend margin requirement for foreign investors, etc. But has it come little faster than you waited because of the Russia's inclusion? Because you need to prepare the ground. We need to have more those particular bonds which foreign investors are allowed to invest in. We need to have more liquidity, and of course, in this kind of geopolitics, always the interest rate risk and the FDI outflow it can happen once you are integrated in the global system. So, as an RBI governor, tell us frankly, sir.
Thank you. Thank you very much, Kamal. And at the outset, let me also thank Business Standard for organizing this event and inviting me to participate in the final session of this 2 days event. I think over the last few years, this event, this particular BFSI event, has emerged as an important event in the BFSI calendar of our country. So my congratulations and compliments to the entire Business Standard team for achieving this. Now, coming to your specific question, you see, our effort over the last few years has been to sort of expand the investor base in our securities market, especially the government securities market, to expand the investor base, and also to provide, sort of greater opportunity for participation. We have taken number of steps. You mentioned about the fully accessible route. We have also taken several other measures to evaluate to a few. And then is this also things like, for example, we have permitted the banks, the domestic banks, to offer margin facilities to the FPIs, etc. Now, inclusion of India in the JP Morgan Bond Index is there decision. And the first thing that has to be recognized in this is that it's a kind of a vote of confidence about the Indian economy and about the Indian financial markets. So, first point I would like to mention is that it's a vote of confidence on our economy, on our financial markets. And I do understand from where your question is coming. Obviously, when you are included in a bond index, it works two ways. It leads to inflow. I mean, the JP Morgan, they have given an estimate of 25 billion US dollars to come over a period of time, and all that is expected. But the other side, on the other side, it's a double-edged weapon. I mean, it's a double-edged sword. That is on one side. The other side, as you know, when there are, there are lots of, there are quite a number of passive investors who get, who are mainly sort of influenced by your weightage in the index. So the reverse can also happen. When your weightage goes down, the passive funds will immediately tend to move out, or if there is, some other development globally happening, it can, there can be outflow of funds. And in this regard, I would like to mention that RBI has a track record over the years, and especially in the recent period, of handling large-scale inflows and large-scale outflows. Last year, after the Ukraine war started, we did not see the kind of outflow which was there after the taper tantrum. Sentimentally, in terms of market sentiment, I think the overseas investors had greater confidence on India's ability to, the RBI's ability to service the outflow of currency. There was never a doubt that RBI will not be able to meet the dollar requirement. That was because of the reserves which we had built up. So our track record over the years, and especially in the last few years, when outflows happened last year after the Ukraine war, it was handled in a very seamless manner. And similarly, when inflows had taken place before that, before the Ukraine war, or in the, let us say during 2019, then particularly in 2020 and 2021, when liquidity was easy all over the world, there was large-scale inflows. And we utilized that opportunity to build up our reserves. So we have a track record of handling both sides of the so-called double-edged weapon of the bond inclusion. We can handle large-scale inflows, we can handle large-scale outflows.
Now, bankers are that they will never ask you, but they in private they whisper into my ears, ask government this.
No. They know it very well, and I doubt whether anybody would have whispered it. But even if they have, and since I am addressing a bigger audience and a wider audience, which perhaps is watching in the in the YouTube and your YouTube through the YouTube facility, let me say that when we say business model, we are not referring to micro-level business models. Why a particular loan is given like this to a particular entity, or why a class of loans, this is the interest rate charged. We are not looking at that. When we say business model, it is from the point of view of the structure and composition, or rather say the structure of the balance sheet of a bank. What kind of risk appetite the bank is providing for, or the bank balance sheet reflects. What is the risk appetite that it reflects, which the bank is, taking? What is the risk appetite in that bank? Whether that risk appetite is matched or backed by adequate risk mitigation measures. So we are looking at more structural issues in the balance sheets. We are also looking at the revenue models of the banks. Short-term risks, short-term gain versus long-term risks. We are looking at issues which every banker does, the asset liability balancing, whether they are appropriately managed, whether they are appropriately balanced, the asset and the liability. So therefore, we are looking at the balance sheet of the banks. When we say we are looking at the business model, we are looking at the business model of the bank as reflected in its balance sheet or as it would feed into the balance sheet is more from the point of view of the structure and the strength of their balance sheet. I have said it earlier that a problem which looks small in some corner of the balance sheet of any financial service provider, bank or non-bank finance company, a small risk which initially appears small in some corner of the balance sheet can become highly risky unless it has been properly understood, unless it has been properly mitigated. So our emphasis is more on that. The second aspect I want to say is that to supplement what I have said, we have now for last several years, we have adopted risk-based supervision. When you are doing risk-based supervision, you have to look at what are the risks which the banks are taking, what are the risks and whether it has been properly addressed by the bank in its balance sheet. So I have said it earlier, but I am just putting things properly. And the recent developments in the advanced, in particular in the United States, some bank failure, and also in Switzerland, the large bank failure there. I think once again, the central banks and the banking sector regulators and supervisors have woken up to the fact that they need to do much more intensive supervision. There is growing realization that many countries, the banking sector supervisors in several countries, let me say, not say many, but in many countries or several whatever, the supervision had somewhat fallen behind the curve. I can say with confidence that our supervision has by no means fallen behind the curve. It has remained in sync with the requirement of the growing complexities of the financial sector, the banking sector world over. So in US, perhaps I'm not commenting on US generally, but I think you will now see more and more, or perhaps we are now even now seeing more and more banking sector supervisors, where central banks are the supervisors, they are doing it, and in certain countries where there are other dedicated supervisors, they are doing it. They have started looking at the business models of the banks. The failure of the particular bank in the United States had a lot to do with the business model, including the old-time directors and the CEO. So when they send it, I would say that in almost all cases, excepting a few, where we find that the increase in package is not commensurate with the business growth of the bank. On the contrary, if the bank has reported a negative, compared to the previous year, if the bank performance is going down, you cannot have a situation of excessive increase in the compensation package. So very few cases where we such things, we put some restrictions. Most of the cases we return it to them, saying that please relook and come back to us. So therefore, we don't put any restriction on that. Second and the most important thing is that first is that the boards of the banks, they fix it and we don't unnecessarily interfere. Second thing is what we have done in our circular on compensation for the private sector banks. It's a principle-based regulation. We have said that the fixed pay and the variable pay, the ratio will be so much. Beyond that, we have not said how much should be the fixed pay, how much should be the variable pay. We have only said that you maintain this ratio. Beyond that, it's a principle-based regulation which we have done. And the Banking Regulation Act expects us to do it. In fact, it mandates that Reserve Bank should approve these compensation packages and ensure that they have used the word. The Act uses the term used in the Act is excessive. It should not be excessive, and it should be commensurate with the size, the growth, and the result, performance, etc. of the banks. So we don't do that. And talking about attrition, I'm just adding one more point, which although you did not ask, we are also looking as a part of our supervision the rate of attrition, which is seen to be high in certain private sector banks, and we have asked them to look at it because they have to really see because every bank also at the end of the day, has to build up its core team, which should really grow with the bank over the years. But the thinking of today's youngsters has changed. Earlier, if you ask any of the senior bankers how many banks or how many institutions they would have worked in the, let's say, last 20, 30, 20 or 30 years, they would maximum say 2 or 3 institutions. I worked in this bank. Then this bank, then I'm here in this institution for last 10 years or 15 years, like that. But it's not so with today's youngsters. So today's youngsters are thinking differently. With so many opportunities, especially coming up from the fintech sector, from NBFC sector, the youngsters, this is a very impatient generation, and nothing wrong with it. Nothing wrong with it. But I think it's for each bank to build up its own, own core team, because there has to be something called the organizational culture. Like, I have come across many executives who proudly say that, I worked in that particular bank for 15 years or 20 years. Now, that is something which will add to their, the credentials and to the CV. So, I just took it aside, and we are now looking at this. RBI has always looked at the attrition, rate in various banks. Now we are looking at it very closely because we find that the times have changed, and banks also need to give greater focus on this rate of attrition. It's for the banks to really analyze and deal with it. The counter view, in fact, somebody pointed out to me is that so be it. If the attrition is high, let that be a charging. Why should you bother? So therefore, there also we have not prescribed any norms or standards. We have just left it to the bank managements. We feel your attrition rate is high. It's for you to do whatever you want to do, because ultimately it will tell upon your organizational, culture, your the building of a core team over a period of time.
Thank you, Governor. So, though if you are Indian, we are just 40 minutes and still I have a few things that we can continue to do, sir, with your permission. In India, I'm just coming to the end. I would like you to, what is your message? Because here there are bankers, there are non-bankers, there are insurance. Everybody is the miniature of Indian financial sector, 750, 800 people sitting here, and there are thousands of people on watching. What would be your final message to them? If you want to say anything. And before that, just with your permission, one personal question. I mean, that people ask me, particularly the people from overseas who join you for discussion, etc. They ask me, they're very intrigued your passion for ties. I said, have you seen governor's ties? And they said that they try to gauge the enormity of the situation, etc., by color of your tie and the tie. Is that correct? Like, if you are happy, you prefer one color. If you are not so happy, if you are in this thing, you prefer another color. Your tie is a mystery. Your love for cricket, everybody knows. Tie, it's a sort of, they try to decipher by looking at your color whether you are going to for a rate hike or status quo you want to reach. So can you tell us a little bit about this? And then,
no, I will be curious to know what is the interpretation they derive from various colors of my tie. It's quite a, I'd be curious
you have
to
a great
know.
collection, right?
Well, I don't know. But let me say that, I don't know if ever I would write a book of memoirs or something. I have never thought about it. I don't take notes or anything to keep it for writing a book. I have never thought about it. But if ever I decide to write a book, I think you have given me some clue that this could be one of the sub-chapters of the color of the time. And perhaps I can give, after my tenure in RBI is over, perhaps I can give a lecture or a speech somewhere about monetary policy and the color of the tie. Talking about
Your message.
message, well,
And because you can see the miniature Indian financial system sitting here.
message, I have been talking about it extensively again and again. I have talked about risk management. Even today I talked about governance. But since you are asking, and since we are in a World Cup season, let me just say the message is to all financial sector players and stakeholders: please play long term, play like Rahul Dravid.